people who are buying SpaceX are not getting in early, okay? This is an exit strategy for the venture capitalists who bought into SpaceX years ago at a fraction of what the general public is being asked to buy it for at the initial trading.
Welcome back to another episode of Off the Wall. Markets are moving fast and we're here to help you stay ahead. So I'm Nate Tonsager, as always, joined virtually this time by co-host Dave Armstrong. Dave,
Yes.
How are you?
Good. I'm here in the pod studio and sorry you couldn't join me, but love our new studio. Love the whole thing going on here.
I know. I almost tried to figure out if I could attach a record album over my shoulder, because that's half the fun of the in-office recordings is when we get to pick out which record we're going to talk about today.
Yeah. And again, I'll make a plea to anybody listening that if you've got any old album covers, I don't need the record, but if you've got old stuff laying around, let me know. Like to switch them up back there. I think I still have the Beatles.
I'm on the hunt for you too.
Yeah. Thanks.
Well, today's, June 10th. We have another AMA episode here. So Ask Monument Anything, where we're trying to, dive into current questions we're getting from listeners, from clients. And normally we do 3 questions, but today I think the 2 topics that we kind of narrowed in on are just so big. We're only going to have time for 2 in an episode. So 2 questions today. And really the first one is going to be around the SpaceX IPO, which I don't know how you could avoid not talking about it or avoid it being in the news if you're paying attention kind of at all to any financial markets. And then the other one's just around kind of current market volatility. Again, we're recording this on June 10th. The past couple of days, there's been some big swings up and down in the market. And I think it's leading to just maybe a little uncertainty or maybe uncomfortable feelings from a lot of people. Mm-hmm. So Dave, again, normally we have 3, we only have 2, but I always like to let you pick. Where do you want to start today?
Let's start with the SpaceX IPO, because that's coming up on Friday. There's a lot of people talking about it. There's a lot of people that shouldn't be talking about it. So let's jump, because you and I share a very similar position on this as it relates to, should this be something that I'm going to call them retail investors, Mr. and Mrs. Smith with retirement incomes and net worth tied up in portfolios and things like that. I'm not talking about like institutional people. I'm talking about real Mr. and Mrs. Smith with real money and a real portfolio. Should they be trying to clamor to get into this thing and listening to all the hype?
Yeah, I think that's a really good distinction right up front, because it is a polarizing kind of topic. And I think breaking it out for, pension funds, large, big institutional hedge funds, things like that are very different than, your average people. And really, I think the questions I'm hearing, again, are more from the average person. It's the people that have worked very hard to build wealth. They're not maybe, again, a $20 million wealthy family. They've accumulated significant wealth. And it's, okay, well, what do I need to be participating in this? Am I missing out on something? I think there's 2 camps. I think, Dave, like you said, we're kind of aligned. I don't think people are missing out by not being part of the SpaceX IPO. I think one of the big reasons people feel like they want to be part of it is SpaceX has grown so much already, but all that growth happened in the private markets. There's a lot of studies out there that's saying companies are staying private a lot longer than they used to. And when we talk about an IPO, it's the initial public offering. So it's when a company goes from a privately held company to offering stock to the public. And there's a lot of things that go on there. But previously, companies would be coming public much sooner in their life cycle. So, right now they're talking about SpaceX is going to be coming to market at a valuation of about $1.8 trillion. That would make it one of the top stocks in the S&P 500 traded on the exchange instantly. But 10 years ago, or maybe even 5 years ago, SpaceX probably would have listed publicly, gone through an IPO process when it was like 2 to 5 billion. And there was still so much more growth potential out there. I'm worried that so much growth has already happened that, this isn't an opportunity for retail investors to really capture that instant or rapid growth from a new company. It's more a liquidity event. For the people that already have shares, It's giving them the opportunity to eventually cash out some of this tremendous gain that they've had in SpaceX as a company.
I think people are just already convinced that this is going to be something that, 10X's as an IPO. And I'm going to get to some statistics on IPOs in a second, because I think it's informative to know what we're talking about when we talk about the performance of IPOs. Okay. That set aside, okay, nobody is missing out. I think people hear these stories about, Bill Gates's secretary who got in on the, ground floor of Microsoft and all, and has now got $25 million because they got in at the beginning. Okay. You're not getting in at the beginning with an IPO. Okay. You're just being allocated shares that will, if you get the IPO, and that's a big if, I'll talk about that too. If you get it, I think it's currently set to price at $135 a share on Friday. If you get an allocation to that, it just means that your purchase price is $135 a share. You've got to then assume that the market is going to elevate the price of that stock up over $135 a share. And it may. It absolutely may.
Yeah, easily could.
Right. But to your point, I don't know how much profit market price appreciation is left baked in from that 135 offering price to where it's going to open on Friday. Now, could it open at $200 a share? Sure. And believe me, I was around in 1999 and 2000 to see these kind of things like go up 100% in a day. So I've seen these kind of silly things happen. But there's some really good statistics about IPOs. And there was an analyst over at Truist Bank that took a look at what was the IPO performance on, the week after, the 1 month after, the 3 months after. Okay. And he went back and he analyzed the performance of the last 30 major IPOs. Okay. Facebook, Twitter, Alibaba, Shopify, Block, Twilio, the Dropbox, Spotify, the ones that people know, right? The people that were like, I'm sure Peloton's in there somewhere too. But anyway, okay. So the big ones, right? Like if you could have gotten into Dropbox or Spotify or Pinterest or one of those other ones, Airbnb, the big ones. After 1 week, okay, the average increase in price from the IPO price 1 week later was plus 4%.
Okay. That's not that exciting.
Well, that's exactly. Okay. And that's kind of, now I've just tipped my hand about what my opinion is on this. Okay. Here's the other statistic that makes it really interesting too, Nate, is that 1 week later of the top 30 big major IPOs, only 57 of them were actually positive. So you're coin flipping here for an on average return 1 week later of 4%. Unless you got pre-IPO shares, I don't think that people should expect to really crush it on this thing. But more importantly, I don't think people should be worried about missing out on it. So to prove that point,
sure.
I'm just going to go across some other statistics. 1 month, 3 months, 6 months, 12 months after those major IPOs. Okay, so average 1 month later, still plus 4%. Still 57% of those 30 securities were positive 1 month later. Okay, now 3 months becomes interesting because now your average return is 20%. So at the 3 month mark, average performance is plus 20% on those 30 IPOs, but still only 57 of them were positive. All right, so you've got to make sure that you're in the 15 or so that are actually positive in the first place. Now, what happens after 3 months? Well, most lockups and things like that, you get to the 6 month. Guess where the average performance is 6 months later? Okay, I'm not going to make you guess. It's 1%.
Yeah.
1% on 43% positive. And then when you get out to 12 months, it's actually a 14% rate of return with 43% positive. The average drawdown on all 30 of those IPO shares is 55% drawdown average. So, I mean, like, I get it. It's exciting because it's on TV and everybody's talking about it. And here's the other thing, Nate. Do not underestimate the power of the barbecue talk on a Saturday about people standing around with their cocktails and saying, oh yeah, I got in on the SpaceX IPO. Did you get on it? And then you feel like, oh, I missed out. I just don't think here's the other thing too. Like if we know that 57 of them don't, or let's just call it 50%, don't even trade above the IPO price, like just wait and buy it on the open market later. Like let the hype die down. Let people who have these massive embedded gains from getting in early, let them sell their shares to take their chips off the table. You probably get the thing at a discount. Here's my prediction. I suspect sometime over the next 6 months, SpaceX will be trading below its initial offering price at some point over the next 6 months. That's a guess.
Below that 135 level. I agree.
That's a guess. I have nothing but my caveman brain influencing my thought on that, but that's just my thought. But I don't know. Take it away, Nate.
I mean, you got a 50-50 shot of being right, Dave. You just played red or black on the casino. So,
exactly.
Well, roughly, right?
Yeah.
And I think that's what's the toughest thing about it is we have no idea what's going to happen. And to, I think, your point, it's pretty likely that I think this SpaceX stock on Friday, when it retail trades, it's going to skyrocket higher. It's going to go to the moon, to use all the stupid puns about space. But realistically, I think you brought up something that is really important to remember is all the initial investors that have all this gain that probably want to diversify because they have a very concentrated position here. It has a huge gain. They can't sell on day one. They have that lockup period that you mentioned that is an X amount of time, whether it's 30 days, 60 days, 90 days. It's usually staggered so that you can do a little bit throughout, the next kind of quarter. But you're going to see a lot of selling pressure on those days, I feel like. And that's normal. That's why you get those 50-50 numbers, is you get some people that want to continue holding it because they're big believers. You get other people who sell a little. You get people who sell a lot. But either way, it's just going to go up. It's going to go down into your statistic there. You're going to have to be able to stomach a 50% drop at some point, over the next year to really get that. I think you said it was a 14% return on average.
Yeah. Now
and that's again, if it happens that way.
Yeah. Now I did read something and I haven't spent a whole lot of time educating myself on all the intricacies of this IPO because I don't plan to participate on it and our clients aren't. We're just right. It's not our jam, not what we do. However, I did read that there were some contractual obligations that were baked into this IPO where the insiders can't sell unless the stock is already 30% above its IPO price. That is an unverified statement that I read. Okay, it could be true, right? Which means at $175 a share is when the selling pressure comes in, right? So anyway, it's going to be interesting. But another interesting thing that I read about SpaceX was a comparison to Amazon. So the IPO is valued at $2 trillion. I'm probably rounding there for SpaceX, right? And Amazon had, right? Amazon is right now at a $2.2 trillion market cap valuation. Okay. Here's the difference. Okay. SpaceX has $15 billion of revenue. That's a lot, right? Like I would take one of those 15 billion, right? I mean, it's a lot of money. Okay. But at the same valuation between space, essentially 2 trillion versus 2.2 trillion for Amazon. Amazon's revenues are $717 billion.
And it's not even just revenue, it's profits. Let's not forget about that. SpaceX is not a profitable company right now.
Yeah, right.
Amazon has become a profitable company, but for a long time, they weren't. So it's still in a growth stage.
Right.
But it's a speculative stock. I have to put it just bluntly that way. It is not a blue chip, giant market cap stock like you think of with your Amazons, your Apples, all those companies that generate a lot of revenue and have these trillion-dollar valuations. It is very different makeup. And there's just a lot of hype and belief that certain pieces of the SpaceX business are going to do very well long term.
Right.
And they might. Again, they really might. I think there is potential in some of their certain business segments. Because that's something else I feel like gets kind of swept under the rug is SpaceX is not just building data centers on the moon, traveling to Mars, the satellite Starlink company with the internet satellite. I think Twitter's also a piece of that. And then there's an AI component as well. The Gronk chatbot is a SpaceX property.
Yeah.
So they're doing a little bit of everything. And that's a really tough business model. You can execute it. It's just really tough to have so many different kind of streams that you're trying to manage revenue.
Right.
And some are profitable, some aren't. You got to pick and choose.
Well, I just keep coming back to, I sense that there's going to be a lot of FOMO going on here. But then I look at, just my experience watching IPOs and really drawing on my experience back from 1999, 2000, 2001, when the IPO market was really, really hot. And here's the thing that investors need to understand about an IPO, right? Is that a majority of those shares are going to big institutions. And you have to just think of the economics and the incentives here, right? So I admittedly don't know who the lead underwriter is for SpaceX. Let's call it Investment Bank X, okay? Investment Bank X is basically taking the company public, along with some other,
Usually
there's
Bank
some,
Y, Z are helping
there's some
out, yeah.
other there's a whole table of underwriters, but usually there's a lead, and we're just going to call this lead Investment Bank X because we don't need to get into all the intricacies of this to make the point that I'm trying to make. They are going to go to their most profitable institutions and say, hey, have we got a hookup for you? Because you do so much business with us, right? As we think about how an IPO works, right? So you're Mr. and Mrs. Smith, and let's just say you've got a really big portfolio. You're probably not getting allocated shares if it's a really, really awesome IPO. It's just the reality of it. So then when I see in the news yesterday that Fidelity has lowered the minimum amount of money you have to have at Fidelity to get into the SpaceX IPO from $500,000 to $2,000 to make it more accessible to the retail. What does that tell you about the institution's appetite for that? Like, there is something really sour tasting about when all of a sudden people at Fidelity with a $2,000, you can open up an account for $2,000 and put in to get out an allocation. I just don't know how much that's really, what that says good about. It's either they're trying to get this thing oversubscribed so it looks really popular or what. But, I come back to, if you didn't get into the IPO, I wouldn't think twice about it at all, especially with the way some other stocks have been doing in just normal portfolios. So I just hope people don't get all wrapped up about the SpaceX IPO and make poor decisions.
Yeah, and I got good news for everyone. Eventually, you're going to own a piece of SpaceX if you own any index ETFs.
That's right. Yeah.
Or any index property. It's going to be a large company. It's going to be part of the S&P 500 ETF at some point, the Russell 1000, maybe even the NASDAQ. It's tough to predict, but normally what happens with an IPO is when a company becomes public, there's a time limit that these index providers, whether it's Russell, MSCI is another big one, the NASDAQ, S&P 500, normally you have to wait about a year before you're even eligible to be included in their index. Well, SpaceX has been so popular that there's been petitions from the industry to get them included faster. So here's the update. Most of them were accepted, meaning SpaceX is going to be included in Russell indexes, so things like the Russell 1000, the Russell 3000, 5 days after it starts trading. Basically, it's going to start trading on Friday. By the end of the next week, it's going to be in that Russell index. Meaning any ETF or fund that tracks the Russell 1000 is going to be buying a piece of it. They're going to have to be buying a piece of it so they can keep their allocation like the index they're tracking.
Right.
The MSCI, it's going to be 10 days. NASDAQ is saying 15 days. Here's what's really interesting to me. The only one to reject the petition is the S&P 500. So S&P 500 said, no, we're waiting a full year before index inclusion for SpaceX.
Okay.
So while everyone else is going to be putting it in quickly, you're going to get allocations through some way, shape, or form of these index funds at some point. You don't need to be a part of the IPO to capture its growth over the long term, which, again, I don't think is going to be exponential. But I do think there's potential that it could be a good stock over a 10 to 20 to 50 year time period.
Concur.
If everything goes right.
Concur. Right. But yeah, you're not really missing out.
Miss out.
Right.
Yeah, exactly.
Well, okay. I'll even give you a more extreme example. Okay. Everybody knows how well Apple has done as a stock, as a company, blah, blah, blah. Okay. So let's just say you didn't get in to the Apple IPO and you just bought it regular market when it went public back in 1980 and you held it for the long term. You're very wealthy if you did that. Okay.
Mhm.
And if you held it through all of the turmoil and everything like that. But what people don't remember about Apple back in 1990 was that it went public at it went public at under $2 billion, which was about 15 times revenue. Okay. So $2 billion, 15 times revenue. SpaceX wants you to buy at a $2 trillion valuation, which is about 100 times revenue in 2026. Yeah. Okay. People who are buying SpaceX are not getting in early. Okay. It's the truth. That's right. This is an exit strategy for the venture capitalists who bought into SpaceX years ago at a fraction of what the general public is being asked to buy it for at the initial trading when it goes public. Okay. That's what's happening here. So again, I just come back to, I don't think anybody's missing out on anything. I think if you want to do it, you should be very careful. I think it should be gambling money. I think it's red or black. My prediction, which I hope I am wrong on, is that there will be a much better entry point for people who want to own it, especially for the long term, if you just be patient and wait a little bit. I'm not opining on whether or not it's a good company. I'm not saying whether or not it has strategic significance in society and in a portfolio for the next 30 years like Apple. I'm just saying, I don't think you've got to get in at the IPO to get into what could potentially be a good company over the next let's just call it long term.
Yep.
Stay out of its way. I'm not interested in buying it.
No, and I'll let it come into the ETFs because again, if it doubles, if it triples, then I get some of that exposure, but I'm not taking all the risk of having to deal with if it doesn't go well. Because in that ETF, right, that index ETF, I still have all these other companies. Mm-hmm. So again, I think there's no reason to feel like you're missing out by not participating in the IPO. You're gonna have exposure to it, and to your point, Dave, it's gambling money if you really do want to play that. Just make sure you're sizing it correctly within your financial life portfolios. Right.
If somebody said, hey, I got into the IPO and I doubled my money inside of 90 days, right? Let's just hypothetically say that happens. Mm-hmm. I'd say that's great. You got $2,000 worth of whatever it is, okay? And you turned it into $4,000. That's great. But that's not the only thing doing that. I mean, we like to talk about Dell Computer. I mean, Dell Computer's gone up almost 200% in the past 45 days. Nobody's talking about that. Yeah. Nobody's saying, gee, I wish I got into Dell for, well, maybe they are, but nobody's talking about it on the news. I mean, there are a lot of securities out there that will do very, very well in the short term based on luck, in the long term based on just good companies. You're not missing anything if you don't get on the SpaceX IPO.
No,
in case I haven't said that enough over the last 15 minutes.
Well, and this is why, again, we are only did 2 questions today. Is because I think we knew we were going to spend a lot of time on SpaceX because it is just such a big thing. But
what else you want to talk about?
Yeah, I think just with the little bit of time that we have here is I think it's really interesting, and clients and listeners are starting to ask about what's going on with the market, and specifically, markets have been very volatile the past couple of days, especially around technology companies. And I think there's a lot of talk of, AI tech bubbles. So the question I think that we could answer is, how long will the current rally in these AI and semiconductor companies and maybe other risk-on assets continue? Personally, I'm not going to make that prediction. I'm going to let the trends tell us where to invest. Because, for example, just to set the stage a little bit, again, we're recording on Wednesday the 10th. The previous Friday, June 5th, markets were down 2%, 2.5%. Monday, they opened back up, positive performance for the day, recovering some of that big declines, especially, the big decline you saw in tech. Well, then Tuesday, yesterday, sell-off happened all over again. we're seeing kind of this whipsawing of buying and selling in these specific kind of tech sectors. But I think it's also really important that you got to look at it over a longer time frame too. So a really good example of, what I think a good way to be a trend investor is if you look at January to April, so of 2026, oil equipment and services was up almost 55% over that time period for those 4 months. Oil, believe it or not, right? With the like just boring old oil.
Yeah.
However, on the flip side, technology software was down 20% for the first 4 months of the year. So you had a big spread there, right? For 4 months, you saw all that performance. Well, in May, in 1 month, that whole narrative flipped. Oil was actually down 6.7%. Software was up 21%. I didn't think anyone saw that coming, and that's why it's impossible to make predictions like that. You would have thought with the Iran conflict still unresolved, oil would continue doing well and risk assets would start doing poorly. Exact opposite happened in May. So it's kind of tough to say, is it going to continue? I don't know. But what I am going to do is, like we always talk about, look at the momentum and that trend data to tell us where we should be invested. And we should be invested in the parts of the market that are going up the fastest or going down the slowest. And so our strategies actually captured some of that with being in oil and services earlier in the year. In May and end of April, making the shift into technology sectors, semiconductors, all those things that have been doing so well, and capturing that month's performance. And now, again, we're seeing some volatility. But that doesn't mean every day we're switching in and out of, I'm a tech investor today, I'm an oil investor tomorrow, I'm a tech investor. Like, you need that meaningful shift to really implement a strategy like this. Take emotion out of it and look for meaningful data shifts is really what it is.
Yeah. I love the fact that whatever's working, we want to be in it, right? And in reality, the explanation as to why is interesting but irrelevant to portfolio management, the way we look at things. When you look at the companies that are trading publicly, their share price is reflective, not 100% reflective of this, because there's some, frothiness and momentum in there, but generally on their ability to earn money, make money. And that's measured by earnings. Okay. So it's interesting to bring this up now because the first quarter reporting is basically ended. Okay. There's never really an end to reporting period. It's not like there's just a generally thought of, okay, when this company reports and 98% of all the S&P 500 companies have reported, that's generally when we say earnings season ended. So as of the end of May, we're going to say that the first quarter earnings season has ended. What is the data from that? Okay. Because the news will make you think that inflation is this and war is that and oil is all of that. Okay, so with 97% of the companies essentially reporting by the end of May of 2026, earnings were up almost 29% year over year. Okay, so let's Dave Armstrong round that up to 30. Okay, so you have a 30% increase in earnings, not revenue, earnings.
Profits, yep.
Profits, okay. So you want to know why the market's doing really well? Strip out all the noise from the news and look at the earnings, because a 30% increase in earnings is pretty damn good. 85% of the companies that reported in the first quarter beat their earnings expectations. 85%. So the other 15% doesn't mean they didn't make money. It just means they made less than they projected they were going to make. Okay, that's pretty good news. And then 81% beat on sales. What was interesting is that the Mag 7, 63% of them beat their earnings, which was interesting, and the average beat rate for the S&P 500 at 85%. I mean, I just think that's all really good news. Companies are making money, and the stock market is reflective of that. Are there other things? Absolutely. But that's a big driver.
It is. And that's why I don't like making predictions. You don't need predictions to be a successful investor. You need to be adaptable.
Right.
And that doesn't mean changing your strategy, but it means having a methodology that can navigate the markets for you. what you need a data-driven process of. If the markets are going up, what are you going to do? And if the markets are going down, what are you going to do? Not predicting, I think the markets are going to go in this direction, or I think oil is going to continue performing well. I think technology may start rolling over, performing poorly. Great, interesting, not actionable. Not until you see kind of the writing is on the wall. Now, here's the kind of balancing act. You also don't want to be too late to anything, which is where that data helps us be reactive, but not, I would say, overly reactive or too slow to react. And it's an art. There's no perfect science behind it, but like zeroing in on the data that can help you make those decisions of when to be reactive without it being too early or too late. That's the golden goose kind of thing. And we strive for that every day in our strategies. So being adaptable and flexible is actually, I think, more important than predicting what's going to happen.
Yeah, right.
Well, I think that kind of closes us out. I know we had to push a question back until next time because again, SpaceX is the talk of the day. We got to talk it to death because man, it's going to be interesting to see. And something we didn't even mention there is there's 2 more big IPOs coming later this year with OpenAI, the ChatGPT maker, and Anthropic, the Claude maker. So this is just part 1 really of what's, I think, going to be an ongoing series of what's going on in the IPO market, given that these are 3 very large companies coming public this year.
Right. Okay, quick trivia for you before we sign off. What's doing better between these 2 things? The S&P 500 index or the REIT ETF?
Ooh, so I would think because interest rates are still high that REITs would be underperforming the S&P 500 this year, but I feel like you're leading me into a trap.
I am. You should know me better. Find out. I mean, the XLRE, which is the ETF that tracks the real estate. You take a look at that because it's trading pretty close to a 52-week high. And last time I looked at it, which was admittedly last week, it was outperforming the S&P 500 year to date. Now,
follow the strength. That's as simple as that.
Right. But a lot of that real estate outperformance is a function of XLRE owning a lot of exposure to AI/data center stuff. It's not like Tanger is doing really well, or like
or apartment buildings.
Right. So you got to just take that with a grain of salt. But still, it's momentum, right? Like nobody's talking about real estate, but here it is quietly creeping up. But the momentum scores and everything that we look at will identify the right time roughly to be in and the right time to not be in it. So anyway, that's just a quick trivia on the way out the door. So
there you go. Maybe we'll call that the 3rd question for today.
Right.
If you ever want your questions answered, because again, we always love hearing from listeners about what they want to hear more from us, reach out to us. You can submit your questions on any of the comments through YouTube, LinkedIn, Instagram, wherever you're seeing the videos. Feel free to drop a comment if you have a question for our next episode, or you can always email us at offthewall@monumentwm.com.
Right.
We look at all of them. We'll find your question. Just please reach out if you have one. We love when we get kind of the engagement. So.
Yeah, definitely. So, all right.
As always, thank you, Dave. Thanks for everyone for tuning in. Make sure to hit the subscribe and follow button so you never miss an episode. So see you next time.
The content presented by Monument Capital Management LLC is intended for general informational and educational purposes only. No portion of this content should be construed as the receipt of or a substitute for personalized investment, financial, legal, or tax advice. Monument is neither a law firm nor an accounting firm, and no content should be interpreted as legal or accounting advice. Any discussions of investment strategies, financial planning concepts, or related topics are general in nature and may not be appropriate for every individual or situation. Different types of investments involve varying degrees of risk, and there can be no assurance that any investment strategy, planning approach, or discussion referenced will be profitable, suitable, or successful for any particular person or circumstance. Past performance is not indicative of future results. From time to time, this content may reference hypothetical situations, illustrative examples, or stories that do not involve actual Monument clients. These scenarios are designed solely to illustrate concepts or demonstrate how Monument might approach similar situations and should not be interpreted as endorsements, testimonials, or guarantees of any particular outcome. No two clients, situations, or experiences are exactly alike, and results will vary. Nothing discussed should be interpreted as a guarantee that any client or prospective client will experience a specific level of results or satisfaction if Monument is engaged or continues to be engaged to provide investment advisory services. Monument's investment advisor's registration status or any prior experience should not be construed as an assurance of future performance or success. Copies of Monument's current Form ADV Part 2A, Disclosure Brochure, and Form CRS, which discuss our advisory services and fees, are available upon request or at www.monumentwealthmanagement.com/disclosures.